Welcome to Onyx and the world of oil derivatives, a podcast that lifts the veil on the opaque world of financial oil trading. Brought to you by Onyx Capital Group, Oil Derivatives Deciphered.
Hello, and welcome to another episode of Onyx and the world of oil derivatives. On this episode, we are discussing physical oil traders and their role in supplying oil around the world, as well as their influence on oil derivatives. Here to discuss this and provide his insights and thoughts is Felipe Elink Schuurman. Felipe has worked at BP and 10 years at Gunvor as a gasoline trader, and is now co-founded and runs Sparta Commodities, a software company that provides trading solutions powered through technology. It's a very interesting discussion. It's a wide range of topics, and I hope you enjoy.
So, Felipe, thanks for joining us today. I guess just starting off with, could you give us some information on your background and what it is you're doing now?
Yeah, thanks, Greg. Yeah, it's a pleasure to be here. So I used to be an oil trader. So I started my career in BP, where I did a Euro graduate program. And basically the first job was in the derivatives team, sales team. At the time it was called Risk, as an analyst. And then the next job I did in BP was a production planner. So I was sitting in the refinery, and I was the sort of interface between the traders sitting in London and the engineers. So managing production based on contango, backwardation, maximizing the optimization of blends and things like that. And then I left BP to join a small shop to trade biofuels. At the time, it was the very early stages of biofuels. And then I was hired by Gunvor to set up the biodiesel desk over there, which I did for 3 or 4 years. And then I was asked to join the gasoline team. And I traded gasoline for more or less 5 years, essentially focusing on the Med, AG, Singapore, and both trading physical and paper. And more than I would say a year and a half ago, I left Gunvor to set up Sparta, and this is my new venture. So I'm the CEO of Sparta, and essentially, well, I will describe a bit more who we are later on, but essentially it's a technology company focusing on assisting traders on their decision making in order to make faster and smarter decisions, if you want.
Perfect. Yeah, we'll definitely talk about that a bit more later on. But I guess, Felipe, you've got a great background to discuss physical oil trading. And as we were just talking about before we started this, the point of this podcast is to shed a bit more light on the dynamics and the working of oil derivatives and that whole world, that ecosystem. And so you very much sat in the physical oil trading space. Just for the sake of summarizing it, of course, I think the wider audience could probably understand straight off the bat, a physical oil trader is moving, buying and selling crude and products around the world. You said you're in gasoline, but generically, how would you say, where does the interaction come in, or where did it come in for you with the actual oil derivatives? Where was the link there?
Well, I mean, the first thing is, when you talk about a physical oil trader, there's a variety of roles, and each one of them tries to extract value in its own way. I would say the first kind of role is the biz dev, who's, whether it's on the buy side or on the sell side, is essentially maintaining relationship. It's the very much merchant kind of trader trying to extract value out of niche opportunities. And this is essentially in places like West Africa or the former Soviet Union and things like that. That would be the first kind of role as a trader, physical oil trader. The second one that I see is the blender. Oil, as it's a liquid product, there's a lot of blending optimization. And the role of a blender, if you want, is to extract value out of basically blending different components to meet the specification for each destination, if you want. And they sit essentially managing terminals and sometimes linked to refineries. So that's the main job, is extracting value out of blending. And then the final role would be more the cargo trader, which the main role of a cargo trader is focusing on arbs. So he would be extracting value out of optimization between different regions and things like that. So I mean, those are, in my opinion, the three main roles as a physical trader. Then, how do they interact with derivatives? Each of them, I would say, interact in a different way. Let's say, I mean, the first thing is hedging, okay, and that's a common component for all of them. You know that the first thing you do in oil, unlike other commodities like ags, for example, where flat price trading is quite common, in oil it's not that much the case. You know, it's you obviously have people trading flat price, but most trading companies prefer to focus on spreads, whether it's product spreads or time spreads or regional spreads, if you want.
Yeah.
So
when we talk about flat price, I just think it's a colloquial term that we use a lot in the oil industry, meaning the outright price of the oil, be it the crude or product. So that's what we mean when we say flat price. But sorry, continue.
Yeah, no, exactly. Yeah. So, I mean, you do have people who have an opinion of the market and they would go long crude or like a hedge fund would do or things like that. But it's in an oil trading company, and particularly physical traders, that is not the main role. So when you use derivatives, essentially to hedge and to hedge pricing exposure. No. So, for example, a blender would be some in the example of gasoline, for example, you would buy some components based on naphtha, some others based on gasoline, and you want to have a common denominator, which is in this case gasoline. So you would generally hedge the gas naphtha, so the spread between gasoline and naphtha. You would also hedge structure. So if you buy a component or a cargo in October and you want to roll it to the next month in November, then you would hedge that structure. Yeah. So this is essentially the tools that you would use, is, you know, the derivative tools that you would use to hedge that pricing exposure. A cargo trader would be more focusing on the pricing between two different centers. You know, so if you are arbing a cargo from Europe to US, you would be hedging the ARB, gasoline ARB in this case, or the East-West if you're moving cargoes to a pricing center that is based on Singapore markets. You know. Yeah. So those are the essential tools, or the essential relationship between a physical trader and the derivatives market. But that being said, you also have obviously some speculation. You know, so you can speculate by, you know, based on your experience and the information that you have about the market, you might decide not to hedge. For example, as I said, the East-West or the gas naphtha. Or you actually overhedge if you want, because you think that, let's say that you think there's going to be a lot of cargoes going from Europe to US, so you want to overhedge that position, you know, and then that fits. I mean, that would fall into the category of speculation, if you want.
Yeah, I mean, there's so much there. I mean, that's great. I mean, off the bat, I think you can tell. You know, the role of an oil trader, I think, to the generic, you know, listener would say basically they're a gambler. You know, an oil trader is buying and selling the generic oil market price, and actually the oil traders, the physical oil traders, have a very big role in the whole dynamics of the oil market. You know, we had a discussion about commodity trade financing on another episode, but that finances these transactions. But just from what you're saying, I can immediately, you know, you immediately get the sense of, without oil traders, all the ecosystem, all the logistics of getting the actual specified products would be impossible without it. So that thing about blending that you were saying, I mean, I for sure think that's something not widely known. I mean, we have all these regions producing lots of crude dug up from the ground, lots of refiners around the world, but of course, within each country, there's own specifications, own regulations, and I guess that was a big part of your job, and navigating, you know, both producing the right products for the right regions and also trying to extract value from one region to another, and that's wherein lay the opportunity. But just more on the logistics point, I mean, you would agree, right? As in, it's without oil traders, it's very difficult to have a smooth oil market, and it's a reason for why.
No, exactly. I mean, the role of an oil trader is ultimately to provide that liquidity to different market participants. So, I mean, depending on the configuration of a refinery, each refinery will produce different kinds of qualities, you know. So, and also depending on the logistics that each refinery has. So if you have, as a refinery, you have a lot of tanks available, then you're able to blend the different components and to be able to then choose whether you want to sell components on their own or if you want to blend them and make finished product, you know.
So, for instance, your
that's
gasoline
particularly
trading.
the case in gasoline, no, of course,
Yeah.
and fuel oil. It's less the case in things like obviously jet or naphtha, where it's more straight run product that is sold as is, if you want. But in things like crude, fuel oil, and gasoline, the blending element is quite useful to extract value out of that. You know?
So just, for instance, the difference between, let's say, UK gasoline and US spec gasoline, there is quite a big difference when it comes to the value difference, right, and the components.
Yeah, no, of course. I mean, in let's say the developed world has similar kinds of qualities. The US, obviously in the US you have a 10% ethanol. I think the main difference comes with other countries. You know, for example, you would have a huge difference of quality between WAF, so West Africa, Algeria, Pakistan, Saudi Arabia, and all of these are centers that import gasoline in a regular basis, as well as the US. And all of these countries have different specifications, whether it's sulfur, RVP, ethanol, the ethanol component of it. So yeah, there's not a single quality that fits all purposes. No? So just because of that, you need to be able to have all this logistics in place to be able to source and to blend the right kind of qualities for each of these destinations. Because in a given month, you might have demand from West Africa, from the US, or from Saudi Arabia in this case. So you need to be able to tailor these different destinations.
So when it comes to trading the derivatives, like you said, it's primarily for hedging for oil traders. Mm-hmm. Now, the interesting thing there is, some people still have differing opinions on what hedging actually means. We always stick by hedging is about mimicking your physical transaction, mimicking the cash flows, making sure the hedge is as accurate to your physical transactions as possible. And obviously, generically, when the market first started, the financial market first started, it was very difficult to get high accuracy because the tradable contracts that were liquid, i.e. able to be traded in reasonable volume at a reasonable price, weren't that readily available. But in the last 5 to 10 years, with the growth of the exchange trading and the rest of it, how has the growth of contracts and the emergence of swaps trading, how has that changed the hedging for physical traders, and maybe specifically gasoline for your case?
Well, it's obviously made it much easier, no? And I think that liquidity is there, and you had market participants like yourselves that have provided a great deal of liquidity to the market, so that you're able to lock in those margins that I was mentioning. Whether it's arbitrage margins or blending margins. So I agree with you. Everyone, especially outside of the oil world, the community, if you want, everyone focuses on the futures. But the reality is that when you're sitting at a Gunvor or a Vitol or whatever, you obviously look at futures, but your main interaction with the derivative market is with swaps. Because, as you said, you want to, whether it's hedging or even speculating, you want to be able to do it on the instrument that you're more comfortable with, that actually is more in line with what you're doing, whether it's EBOB in ARA, it's a whole market on its own. You don't want to be exposed to that market just using futures. So you want to be able to have a proper instrument to hedge your pricing with swaps. In this case. Yeah.
I think definitely what I've seen in the last couple of years, in particular, when trying to market more of our area, the swaps trading, which Onyx focuses on, there's this confusion when you say swaps, and it's understandable. The classic word swap is, much more of a complex interaction for financial markets. When we say swap, we actually mean futures, don't we? It's really confusing, but the CFTC came in with rules that said, any swap dealers, they call them, you've got more tax, and so these swaps are redefined as first line futures. But for all intents and purposes, what we're discussing now, they are futures, right? They're actually contracts that you're trading in the future the main difference between the exchange traded future, like the Brent futures, the RBOB gasoline futures, and the swaps or the first line futures, is that the first line futures are priced by a pricing agency. They're essentially an index that is settled every day, and that index uses real physical barrels or whatever to set the price. And that's obviously very important, because if, like Felipe says, EBOB, which is the European contract for gasoline, that needs to be settled to European gasoline spec, because that might be very different from the Mediterranean gasoline. And therefore, if you want to accurately hedge your physical transaction that involve European gasoline, you want to hedge with a European contract, not a US gasoline. Even though the US gasoline might be more liquid, you want the swap or the first line future that actually correlates to your physical transaction. But have you noticed, surely in the last, I guess you pulled back, is it 2 years ago? Or even when you were trading a couple of years ago, you must have noticed a huge increase in liquidity in the last 5 or so years, and that's really helped. I'm guessing that really helped your job in terms of spotting opportunities and hedging and locking in those opportunities, or did it kill the opportunity to some degree because it was a lot more transparent? Or how did it change?
Well, then you open up a whole new debate here about transparency, and again, the oil industry in general has always been against transparency, if you want, because there was this common conception that you were able, that it was a niche kind of market, and people were able to sort of have an impact in the market, and you didn't want anyone to know what you were doing, and it was quite secretive, if you want. And so the first reaction to transparency was, in general, quite negative. I think that has shifted. I think that now everyone understands that transparency is here to stay. And the whole idea now is to actually embrace that transparency, but with the right tools.
Well, this is the thing. It's great for the market, because if people understand that there's not just these Brent crude futures that you need to trade, to speculate on, or institutions to get exposure to oil. At the moment, they've only really got 1 or 2 or 3 contracts that they can choose from. But if you open up the market to these first line futures or swaps, there's granularity all over the place. There's hundreds of contracts that can all have financial volume that can make more volumes better for everyone, more liquidity, better hedging accuracy. It's a new market. There could be real growth financially. But sorry, I interrupted you there. But I think that's worth.
And I fully agree. And I think that, there's an evolution, if you want, of in the industry over the last years, and we're going more. We went from very merchant type traders where money was made on physical as well as on paper, but it was all about globalization. So being everywhere, having offices everywhere, gathering information from assets. So a lot of traders started acquiring assets in order to gather information from those assets, whether it's terminals or refineries and things like that. And there was a lot of money to be made on physical. Now it's less and less the case. Again, because of transparency, because the moment you do a deal, before you had maybe 1 week or 2 weeks before anyone noticed, now it's maybe half an hour or 10 minutes without, and everyone knows what you just did. But the flip side of that is actually that it allows for other market participants to intervene in this market, because you have more and more information about the physical oil market through the lens of swaps in this case, So I agree, and I foresee in the future there's going to be new market participants that will be more comfortable entering the oil market essentially through swaps, without necessarily having to have physical, to be in the physical space.
But it's I think there's this general idea. I kind of think that people think the Brent crude futures, they think there's some omnipotent force driving it, supply and demand fundamentals. Well, if you actually look at the makeup of Brent futures, it's 5,000 times the underlying physical. It's mostly speculative volume that makes the difference, and it's much more about the open interest and the trading psychology. But when you look at the swaps, or again the first line futures, they are literally priced against physical oil. So it's
Yeah.
much more related to physical supply and demand. So if you want to trade oil on that basis, it makes a lot more sense to use these contracts, provided you can get liquidity. So I think it will grow. But the one thing, you know, I wanted to ask you was, certainly in your time, oil traders were very much dominating the oil space. I mean, I would say, and correct me if I'm wrong, but 10 to 15 years ago, it was actually a lot more about the investment banks. They were taking the most amount of risk. You know, houses like Morgan Stanley had actual physical operations themselves, so they were kind of handling the whole oil trading space in terms of dominating. And then since they've pulled out, you know, the regulatory restrictions, the oil trader kind of became king in the market. But what I think is an emerging trend with the transparency is, yes, new market participants, like you're saying, more financial volumes, but actually we're noticing more and more of the crude producers or general refiners, anyone actually in the physical market, end users or suppliers of the oil, they used to give up their supply, their distribution to oil traders, and now they're saying, well, we can see what's going on and it's more straightforward now because there's transparency. We can do this ourselves. So the BP and Shell, for instance, have always had the trading arm that complements their supply, distribution, the marketing of their oil. But now you're seeing companies, especially in the Middle East, like ADNOC, they've just started supply and trading division. Saudi Aramco are building it up. And do you think this is a trend that's going to continue? And do you think that's going to erode, you know, the competition, to the sense that, you know, the tier 2, tier 3 oil traders in particular are going to be out of the business?
Well, to answer your question, I think that over the last years, and it's a trend that is continuing, there's been a verticalization, if you want, of the business model. So if you were a trader, then you went into assets, you started buying refineries, you started buying distribution, gas stations, and things like that. If you were a refiner, then you started getting into trading. So everyone wanted to basically participate in the market of the other market participant, if you want. So there's what I call a verticalization of the business model. And that has continued, and I think it continues. You see that, as you said, with ADNOC and Saudi Aramco starting to trade more and more, and having offices globally, and basically instead of selling FOB, they now want to capture the whole margin, you know, that includes the trading margin and not just the refining margin. I think that will continue evolving. And the other tendency that you saw is that because of the transparency, you had all these big traders like Traf or Vitol or Gunvor that used to participate in the main areas, but were not as active, if you want, on the niche businesses. So that allowed for a lot of small traders to, you know, focus on that niche areas. But then as transparency came in and margins became lower and lower, the big trading shops started focusing more and more on these niche businesses. So that has also sort of excluded the small second-tier traders. Yes. So, and then you cannot forget that the other massive element that is contributing to that change is the financing. So this is a very highly leveraged business where every oil cargo that you move, you basically put in 10% of equity and 90% is financed by the bank. So you really need a lot of financial support from the banks. And as you know, the banks are basically, a lot of banks are getting out of the commodity trading business, which will not necessarily have an impact on the big traders, but will definitely have an impact on the smaller ones. You know? So yes, I agree. I think there's a tendency to have I think that the big trading companies will become bigger, and you will have this stronger entry of the ADNOCs and the national oil companies, behaving more and more like traders, and probably there's going to be less space for the niche kind of traders. Absolutely.
Yeah, that's really interesting. But when it comes to the evolution of the market, there's been a lot of talk of LNG investment, cleaner fuels. Obviously, BP on a big push right now. They've actually come out and said quite openly that they need to really push the trading, because probably something that's not widely understood is that the trading revenue in majors and trade houses of the majors, and like what we discussed in the ADNOCs, etc., is becoming a really great cash flow for them, right? A really predictable cash flow, and without that, they're going to struggle with downturns like we've had recently, and it's kind of their trump card. So I think everything points to the majors wanting to do more of that trading. So it doesn't necessarily mean the death of the financial oil market, does it? The evolution of going more green and potentially less production of oil and the rest of it. Do you agree with that, or do you think it is going to?
Yeah, no. I think that as we said, the transparency and the best. I would say the best practices that came through compliance and essentially through compliance. Now, as you said, you can actually make a business more predictable. And indeed, BP and Shell would never publish, their trading results, because it was, you wanted to sort of hide that. It was trading meant speculation. And
I think Totso came out and said recently, they literally said, oil trading is a secret. They literally said that publicly.
It was a forbidden. It was a forbidden word, and then now obviously because of the trading results are much better than the refining results. Now they sort of try to demonstrate that their trading abilities are solid, and I think that is a fair case. BP and Shell have been making tremendous amount of money on trading for the last 20 years or more. So it's not something that you need to hide anymore, and I think it's also a question of best practices, and proper risk management and things like that can actually allow you to make it more predictable if you want. It still is a very unpredictable business. You cannot, come up and say this is what's going to be my P&L this year, because you cannot anticipate volatility and things like that. But you actually, but at least you will have the liquidity and transparency that will allow you to go in and out of positions and basically trade more volume. So I think actually you will be trading more volume over the next future. Again, it all depends on demand. There's a huge uncertainty of demand, essentially driven by the new green initiatives. I don't know. Your guess is as good as mine, or as any guess. It's difficult to predict. But assuming that the volumes the physical consumption remains the same, I would expect more volumes on the paper market.
Yeah. Okay. And the transition to LNG, more power trading, maybe with more electricity demand and the rest of it. Are you in the corner which says, you need a very sophisticated market for that to really take hold? Because that was a kind of a subject we covered with the commodity financing episode I did last. It's all well and good saying you want cleaner fuels, you want to push more green. But without an infrastructure like oil, it's very difficult to supply that world properly. And in addition, to really incentivize people to do so, people need to be able to make money. So do you think this push from the trade houses or from the majors to be more green, like BP, for instance, in particular, is that going to help the growth or the more sophistication of the paper market or the financial market in these new contracts? Is that even that important? I'm interested to think what you think of that.
Well, I think that all these major trading houses and major oil companies need to look at the next 30 years down the road, and of course, the demand side is asking for greener products, whether it's LNG or even renewables, etc. So I think most of these trading companies and all that are focusing on that in many different ways. But as you said, you still need to be able to, like any company, you need to have your cash cows, and that provide the necessary cash to invest in new projects. So it's a combination of both. You cannot just simply focus on green initiatives that would maybe potentially give you, provide cash and margins in 10 years' time, but you still need to finance that. So I think it's going to be an equilibrium between both.
But this is what's so interesting, because historically it's okay, the physical market is the physical market, and the financial markets can track the physical markets, and that's great for hedging and the rest of it. But it gets to the point where it's so sophisticated, so many market participants, really dwarfing the physical volumes and a lot of dynamics at play. It gets to the point where it's actually the reverse. The paper moves and the futures move where they want to move, and then people transact in future term deals or even short-term deals in the future. They price against where the current paper market is. So it's actually the paper pricing the physical to some degree. And actually, it makes sense in a way, because if you're, for instance, a producer in the US, a wildcatter, and you need to get financing for digging up some oil, the financing is based on you being able to sell a liquid contract to lock in the cash flow to guarantee the financing. So you can see why a really strong derivative market and sophisticated derivative market can actually help with the growth of the physical market. So you see my point. If there's more effort to grow the financial market in cleaner fuels and green projects and the like, that will actually help the sophistication of the financing and the overall logistics.
Yes,
people don't
definitely.
really discuss.
I would agree with that. Yeah. No, I would definitely agree with that. And but again, it's in the physical, in the oil space, for example. You almost don't have any margins anymore on the physical trading. It's for example, when you look at arbs, if you look at any other industry in the world, you would not, buy a toy in China and sell it in Europe at zero margin. You never do that. But you actually do that in physical oil, and arbs are all constantly traded at break even. Because it allows you to then have a trading paper position, and people actually trade physical in order to obtain a paper position, and it's more and more the case. But again, I think that one of the things that is very important to make people trade more paper is to having a proper understanding of the underlying physical, and you need a bit more transparency there. It is quite surprising that nowadays you don't have the price discovery of gasoline, for example, because of the blending side of gasoline. It's extremely difficult to know what is the FOB ARA or FOB Houston value of any gasoline grade, because you don't really know what's going on the blending side, so you're a bit lost. You have some sort of idea, but you don't, and the more transparency you get there, the more you're going to be able to trade, and I'm thinking of a hedge fund or even someone sitting in Singapore who wants to trade ARBs between Europe and US. He needs to understand the physical underlying of that. Is the ARB open? Is the ARB closed? And things like that. And you need to be able to get that information through cash diffs, through freight, through the actual swaps, etc. You need to understand the physical movement. And once you have that information, then you're much more confident in putting in paper positions.
So that leads on quite well to what you're doing now, right? So Sparta Commodities is a technology company, essentially a software company, which is aiming to bridge this gap as to what you're saying in gasoline.
Yeah, so right now our focus is on gasoline, because that's the market that Miles Mosley and I knew. So my partner's Miles Mosley, he used to trade gasoline for BP. He was the blender in ARA. And we set up this company because we realized that we were using the same tools for the last 15, 20 years to make calculations, to gather information, and it was extremely manual, very time consuming, and the processing tools were essentially Excel. And this is, and then you look at your day-to-day life outside of the office, and everything, you can do everything with 3 clicks on a mobile. There has to be a better way of doing this. So essentially our focus is on assisting traders with technological solutions in order for them to make better decisions, if you want, or data-backed decisions. So what we do is we focus on 3 things. One of them is gathering information. So I think that everyone can have access to futures, but that's just the tip of the iceberg. There's so much more in the oil business, whether it's swaps, cash diffs, freight, and all of them are interconnected. But once you have that information, the raw data, if you want, then you also need to be able to process it. And so, for example, we built freight calculators that are able to give you the freight rate from any origin to any destination for month end to forward months. We have ARB calculators that are able to give you if the ARBs are open or closed. And then obviously the blending tool that allows you to basically run multiple blends continuously. And the interest of this thing is that you're able to gather the raw data, but then provide new data points that are extremely important later on, to be able to know in the past when were the ARBs open, when were they closed, from where, what are the cheaper sources of supply, what are the blending values, what kind of percentages are you using for each component in different blends. And all of these things are things that theoretically you should already have a database of this, but there is no such database in the market. And I think that the market is going, data, and I think Vitol, CIO, mentioned this, they're building data refineries now, no? And the data is potentially going to become the new source of competitive advantage, Before it was essentially having assets to understand what the physical market was doing. But I think that now more and more you're able to use tools like Sparta or to be able to capture the essence of what's going on in the physical market, and then storing all of these data points to then analyze that in the past and make much more data-backed decisions, if you want.
I think, that's sort of, again on the pathway to transparency. It sounds like really interesting piece of software. But you keep mentioning the ARBs, and I think we do need to go through that. For listeners out there, this concept of arbitrage. Why is it important? And again, the general theme of this is always linking back to oil derivatives for the sense of this podcast. Oil traders are moving oil from one location to another. And they're only going to do that at a profit, like Felipe says, or they're going to do it because they can see where the demand is going. They might have a paper position on a financial position, and moving the oil from one area to another, accelerates what they're already expecting. A demand increase relative to another region, or vice versa. But why is this so important? I think for people entering the financial market to understand, or hedgers or anything, it's a huge component of what drives the dynamics of the overall oil market. I think this is definitely misunderstood. Even generally speaking for oil traders, people love to assume that the oil contracts that you trade are reflective of supply and demand, like we said before. But the thing is we trade either futures or first line futures, and they have to be priced against a certain amount of physical. So they're benchmarks. So people get confused. It's not oil, or it's not a gasoline or whatever. It's gasoline in that region. So if we were to take EBOB, again, this is the European contract, ARA contract, that reflects European or Northwest Europe gasoline, this very particular spec. The price of that contract is going to be settled to European very specific spec. So if for whatever reason, the blending components or whatever makes up that gasoline can't be put together and delivered in that area, then the price will skyrocket because it's localized, but it will have a knock-on effect on the benchmark. Now, if you're a trader in the Mediterranean or you're a trader in Russia and you use this contract to hedge, it might be completely disproportionate to what's going on into your market. So you've got to be very careful. And I think generally speaking, it's going back to that argument about paper setting or financial markets settling the physical oil, because you'd think that if you're negotiating, say, for instance, Mediterranean gasoline into West Africa, you'd think, well, it's about the Mediterranean gasoline and it's about the ship that gets them there, the freight, and it's about the local West African market. But they've got to negotiate over a price, right? They've got to negotiate over something, and they choose to negotiate largely on benchmarks. And the likely benchmark they'll choose is EBOB. So if EBOB has a very localized event, they'll start negotiating around a price that's nothing to do with them. It's to do with this localized event. So actually, rather than it just having an impact on one price versus another, these arbitrage movements, if they're to clear one particular region or leave heavy supply or a lack of supply in one region, can have a knock-on effect that actually causes overall gasoline prices to increase because everyone's focusing on just a few benchmarks. And obviously the way to counteract that is to have more and more contracts that are more and more granular, that avoid these kind of localized situations. But I think that has to be said, right? Because I think a lot of people say, I remember my ex-boss, he used to say, look, if you're an oil trader, you've got 2 glasses of water, and let's say one's half full and one's a quarter full. If you pour if you pour some of one glass into another, nothing's changed. There's still the same amount of oil in the world. But I actually don't agree with that in terms of derivatives, because what derivative are you trading? And if suddenly that glass of water or that oil is moved out of that region, then it affects the price of that benchmark, which can then affect global prices. It shouldn't be the case, but it is the case, isn't it? And I think that's generally very misunderstood, and that's the concept of basis, which is very much comes into your calculation within your technology.
Yeah, no, exactly. I mean, the thing is that I would say that ARBs are the most important element right now for an oil trader. You know, if you ask whether it's gas oil, gasoline, or crude, the first thing they look at is ARBs, because yes, the supply and demand remains extremely important, but its impact on pricing is more gradual, where an ARB will actually have a bigger impact on, let's say, a particular contract, let's say November or December EBO. Yeah. So if for whatever reason you're able to export a lot of cargoes from ARA to other destinations, independently where they go, that obviously empties the pocket of that glass of water that you were talking about. Yeah. And then potentially the world has the same amount of oil, but in this particular area, you have less of it. Yeah. And as I mentioned before, unlike other commodities, in oil, people don't really trade that much flat price. I mean, you obviously have a lot of flat price trading, but it's essentially about spreads, whether it's time spreads, product spreads, or geographical spreads. So in this case, it allows you to put in a speculative position on one area versus another area, if you think that Europe is emptying out, or you actually can trade the month spreads. Yeah, and you say, okay, November is going to be much higher than December.
And this explains, a lot of what's going on generally this year, because the WTI going negative. Everyone was talking about that. When I say everyone, I literally mean I was getting texts from people not even in finance. And there's some of the explanations and the analogies were quite funny, and it was a good talking point. But we're so far away from there being an understanding that it was a very localized thing. It was about the Cushing, Oklahoma pricing dynamics that way inland. It's got nothing to do with global crude prices. And, it also explains why you could be sitting in the UK, everything's fine, no disruptions to supply, and then suddenly the price skyrockets. Because there might be some huge West African imports because a political party has come in power and raises the import quotas. Whatever it is, it's like these arbitrages are have huge knock-on effects on global prices, whether it's logical or not. Because I think the general thing we can agree is this whole idea of paper pricing the physical is basically what we're saying, because the financial volumes will go in and profit from that localized event. And that will overwhelm the physical hedging volumes and can push to the extremes. And if you're a physical player negotiating on a benchmark contract, you're just going to have to pay up or sell low. And I guess it's not a really straightforward concept to understand, but I think what you're doing is very important. But it can seem like it's not, because it's arbitrage and it's one region versus the other. But actually, it has huge knock-on effects. And I think what you're talking about and having more transparency there would very much help speculative players, and that's for sure. Because if they're aware,
not just speculative. I mean, I do believe that the hedge fund community, banks and stuff like that would be, and they are. I mean, we started selling our product, and we have some hedge funds that are buying the licenses, but because obviously we provide this level of insights, because it's not just pure raw data, it's actually an insight. An ARB is open, an ARB is closed, this is your blending value, and obviously they have a better understanding of the physical market that then allows them to trade on the paper, because the paper mimics the physical market, as you said very well. But also for physical traders, it's extremely cumbersome to be able to gather the information. The whole industry has historically been organized in data kingdoms, so each individual person within the organization and external parties like brokers will have one piece of the information. So you basically spend your day collecting data from all these participants inside and outside to be able to then just have a general overview with the raw data. And then you need to start processing that data, whether it's blends or ARBs or things like that. And that takes time. And the problem that you have with this is that you miss out on a lot of opportunities, because as a trader, you're basically presented with opportunities all day long. You're solicited all day long. You're constantly being called, and you basically need to say yes, no to all these questions. And not having the right data at the right time in the right format does not allow you to sort of make a confident decision all the time. So you really need to have a lot of experience to be able to do that based on gut feeling. But the idea is that to provide the data-backed assurances to be able to say, okay, given this data, I can take that position, and I don't need to scramble around to find that information because it already comes to you. And that's the whole purpose, if you want. And I think that it's something that we've seen in other industries. And as I said, in the past, maybe if we were 5 years ago, there would be sort of a fight against transparency, but now people actually want to have the right tools to be able to embrace that transparency.
Yeah. All leading to more sophistication, and I'm sure will look very different even in just 5 years' time.
Yeah.
But Felipe, that was really, really great. Thanks so much for your time. And if people want to learn more about Sparta Commodities, you have a website?
Yeah, so spartacommodities.com, you can have a look. So we're launching our minimum viable product. So in the tech world, the MVP, which is the basic product that we go to market with a basic product, and then from there we start building. I'm happy to say we've signed our first customers, so major oil trading companies, niche traders, hedge funds, refiners. So I'm very satisfied with that. As I said, the idea is to start with gasoline and then move on to other products. And I think that I didn't mention before that I think is important as well is that what we want to do, and I think that, and we've seen this in the financial community, is that you want to have as much data as possible to then start making predictive analytics and with the use of machine learning to be able to start trading more algorithmically. And we've seen this in other industries, and I think that in the oil side it's not yet the case because we lack a lot of clean data. And our tool, if you want, provides new data points that are not available in the market that will then allow you to start making more or better predictive analytics.
Very interesting. Thanks very much, Felipe, and listeners out there. Thanks for listening.
Thanks.